I would trust the family management here will look after me as a shareholder. So I'm interested. 4% income, not really grabbing me given the fact that dividend increases may be limited in the near term. But could the shares get down to £1.60? That would give a 5% income, which might be too good to ignore. Maybe I'm being a bit too greedy there, but it's certainly on my radar to look at further.
It's on my radar, and if it went down to 160p, I think it would be in my portfolio as well, probably. As things stand, we'll have to see.
Welcome to the Private Investors Podcast, the podcast where keen stock pickers Roland Head and Maynard Paton talk about managing their share portfolios. Roland writes about his dividend stocks at rolandhead.com, while I write about my small caps at maynardpaton.com. This time we cover James Halstead and the investment potential of vinyl floor coverings. Let's get started.
So, Maynard, floor coverings sound like they could be a bit of a boring investment.
Vinyl flooring is not boring. You could have bought this share for 10 pence back in early 2000, and now they're £2. So you've had a 20 bagger over the last 23 years. Last year, the shares were £3, so a 30 bagger. So fantastic capital gains, plus quite possibly the UK's most reliable company dividend. The dividend has been lifted every year since 1977, so 45 years. So it's fantastic. It sounds boring, but the investment returns have been fantastic.
So what kind of floor coverings are we talking about?
Well, the company designs, manufactures and sells top quality vinyl flooring. Any building where there's lots of people, you probably find this type of flooring. Hospitals, schools, offices, I think they're the sort of bread and butter type buildings. Cinemas, hotels, airports, shops, cruise ships, a whole range of places. The main attraction to the customers is that it's hard wearing. It's not going to wear out with lots of people walking on it. The big product is called Polyfloor, which has been around since 1950. The business has been around since 1914, but the real turning point was in the late 1940s where it hired a pioneering chemist called Bill Roberts, and his work in the lab led to this new Polyfloor vinyl flooring, disrupted the market for lino. So this new flooring became popular because of its durability, and you could get the flooring in a whole wide range of colours. These days you can buy a version with greater grip. So let's say in hospitals, you could use this flooring to prevent vulnerable patients slipping over. Anti-static flooring as well for factories where you've got sensitive electronics and reducing the electrostatic discharge. And also sound reduction as well, sound reduction qualities, perhaps for schools where you don't want children running around and making a lot of noise on the floor. So all these floors are made in the UK on the original site in Bury near Manchester, still on the original site, plus a site on Teesside. And the buyers are attracted to the top quality manufacturing, availability of stock, which is important over the last few years with the supply chain issues, comprehensive range of products and the expert support from the staff as well.
It sounds a bit like the kind of quality business that you might be interested in yourself. Do you currently own shares in James Halstead?
No. It's on the watch list. I think it's an ideal business for long-term buy and hold investors if you can buy at the right price. I wrote about it for SharePad in early 2022. I mean, it's always flagged up on my SharePad screens. It's cash rich, high margin, good dividend record, good return on equity. Lord Lee, famous private investor Lord Lee, he was a non-exec for a time and he wrote about it in the Financial Times. Analyst magazine back in the day wrote about it as well. So it's always been on my radar for years. I guess with the dividend being lifted every year for 45 years, is it on your watch list as well?
Yeah, I don't currently own the stock, but as you say, it's very much on my watch list. And I would say at the moment, I was probably a potential buyer. In the past, I've followed the stock for a number of years and the shares have often looked expensive to me. But the share price is down by 30% since the start of last year, despite fairly strong trading. The dividend yield is now up to almost 4%, which is above average historically for this business. So I'm wondering if I'm starting to see enough value here to consider buying the shares. I'm certainly interested. So what else do we know about this company's products and the way it operates?
I don't know that much about the product, to be honest, but I know it's installed all around the world. So if you look at the recent results, they always talk about where it's been laid, this particular flooring. So the last results, I think, talked about Mauritius, Iceland, Singapore, East Java, and Ukraine. So I think there must be something to this product that makes it sell all around the world. Sales overseas represent 60% of all sales, £180 million last year. So it's pretty significant. The flooring's also been installed in high-profile buildings, which the company likes to name check every so often. So the FIFA Museum in Qatar, the Folies Bergère Theatre in Paris, even the Moët and Chandon VIP area at Royal Ascot even has this polyfloor flooring. On the website, the company talks about the flooring being laid at the Scott base in the Antarctic. So I guess it's difficult to fix things if things go wrong in the South Pole. So I think it's impressive that this flooring has reached Antarctica.
Yeah, I'm definitely impressed by some of those examples. I think it's fair to say the company is trusted by high-end commercial buyers to provide a top quality product and obviously good service too. But I do wonder just slightly whether this could also highlight a possible problem. Looking at the business, the sales and profits have only risen by about 3% a year on average over the last 10 years. So it's not all that exciting in terms of growth. And I wonder whether the low rate of growth could be a sign that the company is maybe competing in a saturated market, or it's reached the limit of its high-end share of the market and is struggling to find new opportunities for growth, perhaps without having to cut prices and attract new types of customer. I think it's fair to say, though, in any case, this business definitely has some durable competitive advantages, doesn't it? Some kind of moat.
Yeah, it has a competitive advantage. It's not a monopoly. So if you look at the recent results or last annual report, they talk about repricing. We have repriced and found volume still goes elsewhere. There's a reality of losing business at high prices or maintaining it at a loss. So yes, the customers are price sensitive and there's a fair bit of competition around. There's another quote which says, flooring contracts can take several months from initial quotation to supply, and it has become ever more difficult to hold to the initial quotation. So they're being caught out a little bit by inflation, the rising prices of the raw materials, and customers are price sensitive. Halstead talked about the overcapacity of supply, and at least one global competitor has fallen into receivership. So it's tricky times for floor covering manufacturers, but Halstead seems to be doing better than most. I think the leading or the largest manufacturer in the UK for floor coverings, there are competitors in the UK, Altro, altro.com, and Amtico, amtico.com. These two companies both have sales of over £100 million each. Profit of just over 8. So they're pretty significant businesses. So there is competition. So this is not Microsoft or anything like that.
The competitors you mentioned, as you say, they're sizable businesses, but much smaller than James Halstead. Do you think the company's very long record of growth and profitability is linked to the fact that it's a family business?
Yes, I think that is the key part to this business. It's a family management story. Family owners tend to care about the business, the product, the people, and that's probably as good a moat as any, especially for this sort of manufacturing business. There's high margins. You can look at the margins and say they're 18%. That suggests customers are willing to pay a premium for this product. There's a long history as well. 70 years, Polyfloor's been around. So you think, wow, over that time, the company's improved its reputation for quality products, product innovation, availability of stock as well. All that comes back to the management, putting all those pieces into place and caring about the business, the fact they own a lot of stock and want to hand it on perhaps to future generations.
So I think it's fair to say, although the company is not immune from competition, it certainly has been able to handle competition, if you like, and maintain a big share of the market for a long time. Let's talk about one or two other interesting aspects of this business. When you were digging through Halstead's annual reports, did you find any sorts of financial niggles?
No. I mean, there was just the pension deficit, but generally there's no restatements, no exceptionals, very clean, very refreshing, actually. The only downside, I think, and it's not a major downside, is the pension deficit, which has been closed now to future accrual, which means liabilities expand as much as they otherwise would. So the scheme's got £70 million of assets. It pays out benefits of £3 million. It requires extra money. It's not self-funding. And £24 million has been pumped into this scheme over the last 10 years. And the pension accounting rules mean that £24 million has not been charged to the income statement. So if it was charged to the income statement, reported profit over that time would have been 5% lower, which is not huge, but it's something to consider. £2 million will be paid into the scheme this year. Again, not huge compared to current profits, which are running at £50 million. So it's not ideal. But when we talked about ITV last time, in the previous episode, and its pension scheme, which was a bit of a black hole, I have to admit, this is nothing like that.
I think also with pensions generally, rising interest rates might make it easier for companies to get rid of their deficit, to manage their deficits and reduce them gradually. So I think probably as in potential investors, there are one or two other more useful things we can focus on. And one thing that really caught my eye in last year's results was the amount of cash that was used to build up stock inventories last year. Too much inventory can be a problem for a business. So do you think this situation is being well managed and under control?
Yes, I do. It's never great when you've got a huge amount of stock, because is that stock being not sold? What's happened? But just to put it into perspective, revenue last year rose 10%, but the amount of stock went up 85%. This was to mitigate the risks associated with the potential inability to manufacture. So effectively, they had to buy a lot of stock because of supply chain issues, just to ensure they could serve the customers. It's not ideal, but they could afford to do this. So the company's cash pile had built up to £83 million the year before, which is huge. Built up this cash pile for a rainy day, and all of a sudden the rainy day appeared with the supply chain difficulties. And so they spent £50 million, as you say, on extra stock. So I think that was to keep the customers happy, make sure they can give the customers good service. And it's good long-term thinking. Historically, the stock provisions have been very low at this business. So I don't think it's all going to go obsolete or anything like that. It will all be sold. But it just made sure they could supply the products that they had quoted and promised the customers, which I think is good long-term management.
Like you say, the vinyl flooring is not a kind of product that quickly becomes obsolete, and being able to afford to fund this from net cash rather than having to use a bank facility also is very reassuring. It really does seem like a good example of the benefits of having a rainy day fund, actually. I mean, companies talk about optimizing their balance sheet, but having this amount of surplus cash actually has worked out very well for the business, I think, hasn't it?
Yes, it has. Cash is good. Cash always gives you flexibility as a business. And you said market theory suggests that you should have an optimized balance sheet and take on debt perhaps. But when bad things happen, pandemics come along, the advantage of having cash and no debt comes into its own. Too much cash is not the worst problem to have as an investor.
No, I couldn't agree more. One area where maybe I do think the company could provide a bit more guidance for investors is succession. We've talked about the quality of the long-term management here, but Chief Executive Mark Halstead, so he's the kind of elder family member, is now 65. I think the finance director is 64 and the chairman is 81. Also, for the first time ever, I think there is no younger member of the Halstead family who's ready to step up and manage the business. So the company hasn't really commented on this yet, except to say that succession planning is an ongoing topic of discussion. But it looks to me like the firm could lose its family management for the first time ever. Would that concern you as a potential buyer?
Yes and no. Yes, you never know what a pro manager can do. They're just not the same. They just don't have the same mindset as a family member. The family members own a lot of stock. They care about the business. They've got family members who will be upset if their shareholding or dividend disappears. The professional chief executive just won't have that sort of feeling about the business. So Mark Halstead, he's in charge. He's been with the company more than 30 years. He's been an executive for more than 20 years. He's been the top executive for 12 years, founded the operations in Europe. He's just a hard act to follow. Simple as that. But family firms, they can adapt to non-family leaders. I own shares in FW Thorpe, which is a family-run commercial lighting business. It's been run by the Thorpe family since the 1930s when it was created, up until 2017. At that point, the long-time MD of the largest division, he took charge. And arguably, the business has improved since then. It's expanded into Europe with some smart and significant acquisitions. Previously, the company is very UK-centric, quite an insular board, just staffed with Thorpe family members and ex-staff. Now it's performing well. It's moved into Europe. It's even got a Dutch non-executive on the board now. So it's broadening its horizons. There are examples of where family management companies have taken on or have appointed a non-family member as the boss and done well. But there's always a risk.
Looking at the current boardroom makeup and some of the existing directors a little bit further down, are there any obvious candidates for people who might be being lined up to take over the business?
No, I have a private investor friend who Halstead shares since 2006, and he's been to the AGM once or twice, and he's confirmed to me there's no fifth generation of Halstead waiting in the wings to take this on. So you look at the senior management team on the website. When I say team, it's just one person, the corporate development director who helps support future growth of the business across the globe. So this director has been and employee since 1996. He has a accountancy background, is in his mid-50s. Is he the potential successor? I should say that Mark Halstead's father, Geoffrey Halstead, he was an executive until he turned 81 years old, and then he finally left the board when he was 87. So Mark Halstead, current chief executive, he's in his 60s. So if he takes the lead from his dad and stays till he's 81, he may be around running the business for another 10 or 15 years, I think. So it may not be an issue just yet.
I suppose with the family firms, you do have to accept that boardroom situations can be a bit more quirky than with a standard listed business, don't you?
Yeah, you do. With this business, the one thing is there's no nomination committee. So in terms of recruiting new non-executives or new directors, I think that's discussed at the Halstead Sunday lunch or something like that, rather than in a formal boardroom committee meeting. So it's a cozy board, let's put it this way. So the non-exec chairman, he was the group's external auditor up till the 1990s. He's served on the board since 2001. So he's definitely a friend of the family. Of the other non-execs, one's a Halstead family member, the other's been on the board for 10 years. So only the fourth non-exec is truly independent, I think. Lord Lee, famous private investor Lord Lee, he was a non-exec in 2000. He was appointed non-exec in early 2000, but was not re-elected at the AGM in December for some reason, which was not disclosed. So he lasted less than a year. I don't think he was a friend of the family. And when he was not re-elected, a week later, the non-exec chairman and another non-exec resigned. So back then, Geoffrey Halstead was calling the shots. I think he thought maybe I could do without these non-execs.
Yeah, that's all very interesting. And as you say, it's a bit hard to know exactly what to make of it. But I suppose more generally in the business, I know that the company has commented in the annual report that given that the length of service, many of their senior managers are very long serving. And they say that this could mean that succession planning becomes a risk or an uncertainty. The company says it has an open approach to decision making, which helps to mitigate it. So presumably there are plenty of younger and more junior employees who are being trained up and could step in if needed. With such a long-serving staff profile, I do get the impression there must be a good working environment. But if I was going to play devil's advocate then, I might say that is this a slightly insular business that's become dependent on a core of older staff who are very good, but might soon be heading for retirement? You could even suggest that the lack of growth is maybe down to a lack of ideas because so many people have worked together for so long.
I get that point. There's a great video on the website, which was made a few years ago when they were celebrating their 100-year anniversary. It talked then about 25-year and 40-year long service clubs and the staff getting carriage clocks for 40 years. But I don't think this is a business where the culture of staff are becoming too comfortable. Look at the revenue per employee. That's been tracking higher every year, I think, for the last 30 years or something like that on SharePad. It's now £360,000 per employee sales. So they're getting more out of their staff every year. So I don't think productivity is a problem. You look at the annual report, there's a good line in the annual report which says one such indicator that is under close scrutiny is absenteeism. That's mentioned 4 times in the annual report. I can't recall ever reading absenteeism.
No, it seems an old-fashioned word now, doesn't it?
It does, but I can't recall any other annual report mentioning absenteeism, which gives me the impression that they're on the lookout for skivers. So they do say absenteeism is still above normal levels that existed prior to the pandemic. And there's also another line which says, we require each subsidiary director to undertake a written report on their area, and often these include key indicators. Obvious examples are absenteeism, debtor days, and margin by product line. I get the impression if you are coasting along at Halstead, you will be found out pretty quickly.
Yeah, that seems pretty reasonable from what you say. They obviously do manage the business very closely and in a maybe quite a traditional way, but quite a rigorous way. So that's all good. One other area that perhaps we should discuss is pay. Obviously, this is a very successful business, but my impression is that the top leadership team are also quite well paid for a business of this size.
Well, let's put it this way. They're not thin cats. So Mark Halstead, his basic pay is £463,000 a year. Last year, he took home a bonus of $500,000. Looking at the annual reports, the directors have been paid a bonus every year for years, and the bonus performance is determined by index-linked profit improvements through a trend of earnings per share growth. And you look back over the last 10 years, and earnings per share have grown at 3% a year. Is that worth a bonus every year? I'm not so sure, to be honest. Is that worth a bonus of £400,000 to £500,000 a year? Not so sure. So the basic pay is up 3% in line with the wider wider business. I guess that's something. But the disclosure is really poor. You've got parts of the remuneration details in the remuneration report, and other parts are hidden away in the accounting notes. There's not a proper table in the remuneration report listing every director and what they get paid basic, plus the benefits and any bonuses. So disclosure is poor, not impressive. But you've got the track record here to back it all up. So you can accept it's a quirk given the fantastic track record. On the pay, effectively, if it's not broke, you don't fix it. So you just got to accept it, I think.
Yeah, it's like you say, there's such a strong record. We're inclined to be a bit more accommodating. I think if there was a poor record, we'd probably be a bit more critical. But even with such a large proportion of the shares held by the family anyway, I suppose they have a certain amount of control, but also maybe accountability to each other about the performance of the business. There are a lot of shares that are effectively out of public hands, aren't there?
Yeah, so Mark Halstead, he's chief executive. He owns 26.5 million shares. So that's an investment of £53 million. Michael Halstead, he's a non-exec, fourth generation family member. He's got shares worth £3 million. The John Halstead settlement. So John Halstead was Mark Halstead's grandfather. So this settlement is a family trust. John Halstead's children, grandchildren, great-grandchildren, and so on. They've got shares worth £142 million. And so my private investor friend says there are more than 200 family shareholders in this business. The website says shares worth about £250 million and not in the public hands. Trying to put an accurate figure what the family own is difficult based on the sort of weird way the stock market disclosure rules are, but it's at least £250 million. I suspect it's a lot more. So the directors, the close associates, and the wider family own a ton of stock here.
Yeah, I think there's another large shareholding that's shareholders collectively referred to as Rule-Gale nominees, which basically is a group of private shareholders who own their shares through a stockbroker called James Sharp in Bury, so near Manchester. And collectively, I think the Rule-Gale nominees holding is about 17%, so that's around £140 million. We don't know who they are, and as they could be family members, but I'm not sure that's true here, because one good thing I've noticed about this business is that it has a very long-standing employee share ownership program. So basically, these types of schemes allow employees to buy shares at discounted prices. So the company says that they've always been based around Bury, and they say that the vast majority of UK employees are shareholders. So I wonder if the Rule-Gale nominees shareholding represents the collective shareholding of all of Halstead's past and present employees. And that might explain the regional location of the stockbroker and the unusual size of the shareholding, because it is a bit of an odd combination, isn't it?
Yeah, the shareholder register is quite confusing, but I think you're probably right on the Rule-Gale nominees. It's all staff, former staff. And this is an old school business. It is truly old school, which is good because there's a good line from the chairman in the annual report. For many companies, some shareholders are transient and focus short term, looking for ambitious acquisitions or risky strategies, and then are quick to exit at the first sign of problems. Management need to be focused on the medium to long term, which sounds really good. They don't like social media either. As a group, we do not find social media, Facebook and Twitter, an appropriate medium for dissemination of news due to the soundbite nature of the medium. And there's no investor PowerPoints either. So if you go to the website, you just get the annual reports. There's no flash PowerPoints, presentations, or anything like that for investors. So it's very old school, very quirky of this family management company.
Yeah, I've noticed the lack of presentations when I was looking into it. You have to be willing to do the hard work and read the annual report, don't you? Even so, though, I think you have actually discussed some of these concerns that we've been talking about directly with the company, haven't you, in the past?
Well, I had an email or two from the finance director. So he wrote to me after reading my SharePad article last year, and he said, liked the write-up. We didn't pay you, did we? I said, no, sadly you didn't. But he said he had a few shareholders sending it in. And for someone who hasn't talked to us, it was well researched, which I think was pretty good. Getting a little compliment from the finance director. Not always happens to me, I should add. He also mentioned that, yes, he and the chief executive were getting old. COVID-19 put paid to easing down. So I'm not sure if they were planning to ease down just before COVID struck. He did say the virus called for a lot of experience, and also on the accounting. He also talked about the dreaded EBITDA, so he likes clear accounting. So that was pretty positive as well. Going back to quirks of the company, I own quite a few family management type companies. So Thorpe, I've mentioned, Mount View Estates, and S&U as well. These are all quirky family companies, and they've all delivered multi-bagger gains over the last few decades, plus fantastic dividend returns as well. And yet they all contravene corporate best practices. They run it like they want to run it, build long-term value. And so if you get involved in the right companies with the right people, you can overlook some of the quirks in the reporting and so on, but they've got to deliver. So as a private investor, you're always a minority investor in public companies, but with these sort of family companies, you are definitely a minority investor, certainly in Halstead.
One topic we haven't really discussed at all in previous episodes of the podcast is sustainability. I suppose for some of the companies we've talked about before, like Bioventix and ITV, this probably isn't really a big concern. But James Halstead is obviously an industrial business. I think it's a bit different. The main raw material used in vinyl flooring is PVC. So really it's a kind of almost, you could say vinyl flooring is basically plastic, and certainly making it is an energy intensive process at the factory and in the refineries where some of the raw materials come from. So I know the company says there are some biomass products coming into use. PVC isn't all just petrochemicals anymore, but James Halstead, as far as I can tell, isn't producing these biomass versions of vinyl flooring themselves yet. The company does seem to be quite aware of the challenges with sustainability, though. For a number of years, they've run a recycling scheme called RecoFloor, and today management say that polyfloor contains up to 40% recycled materials. So perhaps that aspect of things isn't too much of a worry, but I think one thing that's much harder to escape is energy usage. Going back to, we were talking about the inventories and how they were increased for the winter. And one of the big reasons for that really was that management were worried that energy supplies in Europe might have been disrupted during the winter, and that could have delayed production and prevented them from fulfilling orders in their timely way as part of their service offer. So as it turned out, that didn't happen, but James Halstead's UK factories definitely do burn through a lot of electricity and gas, don't they?
Yeah, they do. Companies have to disclose or should disclose how much energy usage they use every year. So for Halstead last year, it was 75 million kilowatt hours. This time last year, I looked at 16 companies I've reviewed, just judge exactly how much energy companies use and which ones are more vulnerable to higher energy prices. So I looked at 16 companies and Halstead was the fifth most energy intensive. I compared revenue to the amount of energy they used. So Halstead was number 5. The top 4 were Fuller Smith & Turner, the pubs group, Goodwin, which is a heavy engineer, Victrex, which makes chemicals, and Greggs, the sausage roll retailer. So yeah, there's no getting away from it. Halstead is a energy intensive company, and higher energy costs will hit profits, which we saw in the latest half year results in March, where the margins were trimmed from 18% historically down to 15%. So it's energy intensive. What did you think of those results?
I think they were pretty respectable in the circumstances. The actual accounts covered the second half of last year, so coming into winter when there was a lot of concern about energy and costs were still really high. So yeah, I think the results weren't too bad. Although sales rose by nearly 10% to just under 150 million for the half year, but pre-tax profit was down 9%. And again, this is a story we've seen a lot recently. James Halstead has put up prices, but there's a lag on passing through some of these higher costs, and I think in some cases they may not have chosen to pass on the full increase in order to protect their order book, but no real concerns having been through the numbers. What was your view on them?
Yeah, I like one line in these results. They took a more protective stance towards long-term relationships. So effectively, they had a dilemma. Do they pass on the costs, the higher cost to the customer, or take the margin hit today? And so they took the margin hit because they wanted to effectively create greater customer goodwill for tomorrow. So how many chief executives think like that? Not many. I think most of them would put the prices up to please the city over the short term. But because you've got a long-term family ownership mindset here, they were happy to take the margin loss, ensure the customers were happy, and they'd come back again in the future to buy more floor covering. Very acceptable results given the circumstances. The dividend, the all-important dividend, that was held. And the previous final dividend, that was held as well. So you've talked earlier about the 45-year run of increasing dividends. All hangs on the final dividend to be declared in October. If that is held as well, the 45-year run is over. There's cash of 44 million on the balance sheet in no debt. I suspect they will just increase the final dividend a fraction to make it 46 years of rising dividends. That's my guess. The best thing I think from these results is the stock level decrease, because we talked earlier about the stock levels increasing last year by 85%. So they've come back down now to normal, I think a normal level. So about about 30% of revenue, which is in line with what Halstead saw before the pandemic. And stock levels are continuing to fall into the second half as well. So that's freeing up a bit of cash. And I think the final dividend in October will be lifted a fraction just to keep the record going.
Yeah, I think you're almost certainly right, especially as you say, because they have the cash available to fund it if they need to, as well as ongoing profits. Looking at the valuation of the business, we mentioned earlier the dividend yield is just under 4%, I think, with the shares where they are while we're talking today. Looking at it, for me, the big question is how much of a premium is it worth paying for something? I think it's proven to be a high quality business, but you might say there's perhaps a little bit of growth risk and maybe some slight uncertainty about future leadership. So the dividend, at 4%, the yield is, by my reckoning, it's actually the highest yield the shares have offered since 2010. And that in itself could be a sign of value, because obviously back then we were emerging from the financial crisis and markets were still pretty pessimistic. More broadly, I suppose, one measure I've been looking at is EBIT yield. So that's basically comparing operating profit with the value of the business. And James Halstead, I reckon, currently has an EBIT yield of about 6%, which for me would be a reasonable price. A cheap price would maybe be an 8% EBIT yield. So as things stand, I think the shares look reasonably valued, if not maybe quite as cheap as I'd like. How do you see the valuation at the moment?
The share price is back at levels first seen 2015. So going back 8 years now. So it's certainly a share that is worth investigating, given that the share price is back to where it was 8 years ago. Have you read the book One Up on Wall Street by Peter Lynch?
I have done quite a few years ago, but I have done, yes.
This is one of the first books I ever read about investing. It's a great book. It's about 30 years old. So Peter Lynch was a fund manager in America. So he joined Fidelity and he took on a fund. And within 10 years, after 10 years of taking on this fund, the fund went up 19 times, which is amazing. So he's a great stock picker, wrote a book. And in this book, he devised a checklist to find the perfect stock. And on this checklist was checklist point number 1, it sounds dull. James Halstead, the name just sounds dull. Checklist point number 2 from Peter Lynch, it does something dull. Floor coverings, check, that sounds dull as well. Another point was it operates in a no-growth industry, 3% earnings growth a year. Yes, that sounds no growth. So it's a type of stock Peter Lynch would like, I think. I suspect he would be a fan. I'm a fan. The financials are great. The track record's great. The management are great. I can live with the succession and pay issues. I don't know that much about the product. I can order some free samples from polyfloor.com if I was really keen. It can even go on a training course as well in Manchester for 2 days if I really wanted to. But I would trust the family management here will look after me as a shareholder. So I'm interested. 4% income, it's not really grabbing me given the fact that dividend increases may be limited in the near term. But could the shares get down to £1.60? That would give a 5% income, which might be too good to ignore. Maybe I'm being a bit too greedy then, but it's certainly on my radar to look at further.
It's on my radar, and if it went down to 160p, I think it would be in my portfolio as well, probably. As things stand, we'll have to see, but it certainly sounds a good dull investment to consider for a long-term hold.
Vinyl flooring is not boring. Well, that's it for this time. Thanks for listening to the Private Investors Podcast. If you enjoyed the podcast, please let us know by liking, subscribing, or even leaving a review. Until next time, thank you and goodbye.